The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Welcome to Something More with Chris Boyd. Thanks for being with us. I'm here with Jeff Perry, investment advisor representative with Asset Management Resources, and our Chief Investment Officer, Brian Regan. Thanks, guys, for being with me.
Good morning.
Good to have you here. So lots to talk about. And our segment today, I think we're going to start off with is talking about what's been happening in the markets and the economy, some recent economic data that's certainly relevant. And to help us navigate some of that, we've got Brian Regan to do that. But Jeff Perry, do you want to sort of start us off with some considerations of what to focus on first?
To be a wise guy, I guess, to start off, I'm going to say, where's the recession? Where's the recession? Because we've talked about, or a lot of people have been talking about a pending recession. Not us. We talk about it, but so the third quarter numbers just came out. We're here at the end of October. So the GDP, the gross domestic product, which is a measure of all the goods and services produced in the United States, the initial look, as they say, of the increase for the third quarter, it is an increase, so not a recession, was 4.9 annualized rate for the third quarter, and there was an estimate out there of 4.7. And according to the data released this past week, the increases came due to contributions from consumer spending, consumers still strong, increased inventories, exports, residential investments, and of course, my least favorite one, government spending. So it looks like to me, at least on the surface, and I'm really excited to hear what Brian has to say and dig into this, the economy is rolling right along.
Is near 5%.
Yep.
A good number, Brian?
It's an unbelievable number. It's just shocking, and it's really what's driven, in part, is what has been driving the 10-year Treasury rate to accelerate so high, as you know, it starts to price in this excessive growth that we're having. You know, that's almost 3% higher than what you would consider to be good. So it's not good. It's eye-poppingly good.
It's fabulous.
It's actually a little bit lower than what the Atlanta Fed was predicting at 5.5%, which is why I think the initial reaction was a rally in the 10-year Treasury market, which is, you know, a good thing. I'd love to see more rallies in the 10-year Treasury. This constant unabated sell-off has been, you know, difficult to handle for the stock market and the average bond investor.
Brian, how much of, when you're looking at a number like this, we'll round it up at 5% GDP, how much of this is caused by inflation itself, right? Rising prices? None of it.
These are real numbers. So they're adjusted for inflation. That's what real means. So this is not a reflection of inflation. This is a reflection of activity in the economy adjusted for inflation.
Very good.
Yeah, so it's an eye-popping number. So people are still spending, and I think people will continue to spend as long as they have jobs. And I think that the labor economy, you know, the labor market's going to continue to be strong as long as we get continued inflows, you know, in the labor force. So all that's happening. When that ends is you know, it's been a topic of great debate for a long time now, as you introed, Jeff, when we started this conversation.
Right.
But it hasn't happened. It hasn't come into fruition yet.
And what does it tell you does this impact the Fed at all in their process of trying to slow the economy? I mean, this is a pretty strong number. I know you might have some comments about other factors, but this number alone, does it make the Fed reconsider and maybe start tightening again?
Well, the Fed has said that they want to see below trend growth, and this is well above trend. I mean,
Right.
This is more. This is like 2.5 times trend. So if they want to see below 2% growth, this is definitely fodder for them to hike more. That I do think that it seems like the voting members are a little split on the subject. The expectation is one more hike for the year, but many members have said, I think accurately, that the market is doing the tightening for them. Right, when the 10-year Treasury goes from 3.5% to 5% in a matter of 3 months, that's going to have severe consequences on the money markets. And when you see mortgages go from 3% to 8% over a year and a half, it's gonna have a big influence. So whether or not they raise another 25 points, I think is almost a moot point. And they'll probably do it. I think the expectation is that they'll do it. They've said that they'd like to do it. But ultimately, I think another 25 basis points on the front end of the curve is less important than the surge that we're seeing in the longer term Treasury.
How much is the focus on this? So is on the consumer, the consumption as being a driver. How much do you think that's a lasting impact that in itself could have some slowing effect on the GDP over time?
Well, the personal savings rate actually dropped. If you look at the report, quarter over quarter, at least, it was personal saving was $777 billion compared to 1.04 trillion in the second quarter. So people are spending and saving less. There is an end to that, as we all know. We are going to talk about the webinar, but I had a nice chart in the webinar from the San Francisco Fed that shows that the excess savings that was pent up from the pandemic is mostly all spent down. We've seen a cycle here, right? Initially during the pandemic, all the spending went towards goods because we couldn't go out and enjoy our services. That was a driver for inflation. And then once the world opened up, that flipped. The drivers of inflation became services, most notably household formation. But also everyday services. We're seeing a lot of spending on food away from home, for example. We're seeing a lot of inflation in food away from home. And if you look at the most recent PMI service PMIs, it's interesting that it's dropped below 50, which means it's in contraction territory. So, there's reason to believe that this number isn't going to last. It seems almost impossible to last. I mean, this is a number that's not even close to the norm of what we should be seeing in the United States. So it's going to be interesting to see how the services data continues to trickle in. One thing that we have seen is the survey data, or what they call soft data, has been completely different than the actual hard data. So what people are saying in surveys and what people are doing in reality are completely in contrast to each other, which is an interesting thing to note. If anybody tries to make a bearish point of view, they tend to be pointing towards this quote unquote soft data, which is basically surveys. And it just hasn't been in line with any of the hard data, which is really fascinating to me.
Not sure. I'd like you to elaborate on that, though. And what are you referring to in terms of soft data, hard data? Yeah,
so soft data is call people up on the phone and say, "How do you feel about the economy?" Right, like consumer sentiment kind of thing.
Mm-hmm.
How are you better off today than you were 3 months ago? Do you think you're going to be better off 6 months from now?
So people's sentiment is generally kind of frustrated, but their numbers are pretty good, you're saying?
The numbers aren't pretty good. The hard data, like this GDP number, is an example of hard data. It's a measurement of actual goods being spent in the economy. Is unbelievably good, right? The services actual data that we've seen, like the consumption numbers that we're seeing, are fantastic, right? I mean, it's real. The consumption numbers are really what's driving this accelerated GDP number. You know, it's kind of amazing that we're still seeing an investment in inventories, for example. Not only is the consumer spending, but businesses are restocking the shelves. And, you know, there's how many times have you heard CEOs saying that they're battening down the hatches for a possible recession? And it's just that those comments are not in line with what I'm seeing here, where private inventory investments are up. So, you know, this is just indicative of an extremely strong economy, despite what people feel and think and say.
So, Brian, in the context of the earnings season, we're in earnings season where the third quarter earnings of publicly traded companies have been briskly coming out each and every day, morning and afternoon. Not looking for a deep analysis because they're still coming in, and you know you need to get a broader picture. But what's your sentiment if someone called you and surveyed you on how do you think the earnings are standing up in this third quarter thus far?
I thought the large bank earnings were very good. Microsoft's earnings was very good. Google beat on the top and bottom line, but if you actually look at the report, there's no growth. Expenses were up, margins were down. I understand the sell-off, even if it is in contrast to the headlines. And that Google is a big part of the S&P 500. It's a big part of the NASDAQ. When it's down 10% in one day, it's going to have a big drag on the market. But we should really note how strong Microsoft was. I mean, their cloud growth is north of 20%, and this is one of the biggest companies in the world. Having that kind of growth is exceptional. I mean, it's unheard of. They, in my opinion, have the best social media site, and nobody even talks about it, right? Which they own LinkedIn, and they're applying AI all across the board, from applications in the cloud that are being built by their customers to everyday stuff that you will do in your Windows operating system. They did fantastic. So it's going to be interesting. I think NVIDIA statistically is the big one. If there's an interesting stat that if you take them out of the technology sector, the expected earnings growth rate actually turns negative, just from one company. Their earnings growth is supposed to be so large that I think the tech sector would go from 4% to -2% if you took them out. So when they report, there's going to be a lot of attention on that. I think there's a big expectation that the earnings were going to trough this quarter.
Right.
I think it's being very average. Kind of coming right in line. Normally around 70% of companies beat their earnings estimates because they sandbag their guidance, and it's coming in around that so far. It's been okay. I mean, there's nothing to be excited about. There's nothing to be too scared about, and I'm very interested to see what NVIDIA comes in with, since it seems like a lot's riding on their earnings call.
When you see a company like UPS, which came out this past week with earnings, and they were a little disappointing, does that make you worry about economic activity? Do you look at certain companies like a FedEx or a UPS or maybe an Amazon even to get a future view or a current view of how the consumer is looking and how business activity may or may not be increasing or decreasing?
I think that used to be a big thing. Like, look at the transports, right? They're supposed to get some kind of eye into the market. Personally, I don't agree with that. The transports, I'd rather look at Amazon, for example. Amazon is, we all know what Amazon does, right? It's the world's biggest store, but it's also the biggest or second biggest cloud provider. Right. So it kind of gives you a read through to the consumer discretionary sector, but also the technology sector. So that's something that I'd be more interested in rather than what UPS is doing. I mean, Amazon has its own distribution system too. Interestingly enough, FedEx and UPS, they haven't been good stocks for a long time. I don't personally, I don't really pay too much attention to them. What I am very interested in right now is, you're going to think I'm crazy. Who cares about this? But I'm really interested in regulated utilities. They've fallen so dramatically as the 10-year has risen. And some of these have very consistent, because they're regulated utilities, earnings growth, dividend growth, and they're paying very attractive yields right now. So, when it comes to the overall earnings sector, I'm going to concentrate on the things that are top heavy, like Amazon. But when I'm looking at things that represent value right now, I'm looking at, regulated utilities, and even utilities that aren't regulated, like, Verizon, for example, I think reached close to a 9% yield. The company's not growing, probably not going to see much of a raise in the dividend. But a 9% yield is 5% greater than, or 4% greater than the 10-year treasury, for a company that's got very reliable financial statements and can cut back on capex and increase cash flow, as we've seen in the last quarter.
Yeah, both AT&T and Verizon had solid earnings, recently. Not, as you said, they're not big growth companies, but they certainly seem capable of sustaining those dividend payments. And, sometimes people buy a stock for that dividend yield, not even looking for any capital appreciation, right?
That's not the way I approach it. Normally, when a dividend gets way up in the sky, oftentimes it means that the companies can't pay the dividend, and it's gonna be cut. But when you see a company that can pay the dividend, that has a sky high dividend, it could be a great buying opportunity. And to me, I look at it as, hey, great, I'll take the yield. But I also think it's only a matter of time until the market figures this out and we get a big capital gain. One of my favorite stocks to do this historically has been Universal Group, which is a tobacco company. What they do is they have dried tobacco. And if you know anything about dried tobacco, it doesn't really go bad. It's like, I don't know, smoked. It's like dried out meats, right? In a way.
So Slim Jims don't expire, right?
It can sit on the shelf forever, and we know that tobacco is addictive. And sometimes, they usually trade between, $60 and $50, and then sometimes it drops, below 40. And you get a big fat dividend yield, and it's just a consistent business, where sometimes the prices get out of whack, and when that happens, it's usually not long until, not long from an investor speak. It could take a year, could take 2 years before something in that low 40s, 8-9% dividend range pops back up to 50 or 60.
Is it back to utilities for a second? Is that what you're kind of a similar thinking? You're thinking that the prices of utility stocks have gone down because investors have had other options to get yield, and if that scenario changes, they're going to become more attractive again for the investors who are seeking such a yield?
Yeah, I think that's the major driver. There's also kind of a unique driver. So the index, if you're looking for like an ETF ticker on the utility index, it's XLU, and the biggest company in that by far is NextEra Energy. And NextEra Energy is composed of two companies. One's a regulated utility, Florida Power and Light. Jeff, it's probably who you pay.
It is. It is. And they have great rates, by the way. Amazing rates.
And they have a regulated utility, and then they have a for-profit business, which is not a regulated utility. And this is by far the biggest company. And in one of their businesses, they were cutting a dividend, and that stock dropped 50% inside a week. So I think that caused selling pressure on the index as a whole. And when that's the biggest stock in the index, it's going to affect all the other stocks in the index, even if they're 100% regulated utilities. And if anybody doesn't understand how a regulated utility works, I'll give you a quick background. Very basically, they have monopolies, and the state determines how much return on their investment, on their equity capital that they're going to get. So they're going to get 100% of their debt payment through. They're going to pass it on to the customer. They're going to get 100% of all their expenses, and then they're going to get 10% on their equity. So as long as they keep coming up with projects or maintenance or anything to grow their capital base, they're going to grow at the rate that their capital base grows. And now with the Inflation Reduction Act, there's heavy incentives for people to invest in clean energy. So now we have these massive projects. Dominion Energy, for example, has, I think, don't quote me on this, but I think around $70 billion in projects in the pipeline. You say half of that is financed with equity. That means they, reasonably you could expect their revenue to grow by $3.5 billion, which is about the amount that they have in profit today. So, the analysis needs to go a little bit deeper there, but you can imagine that if the state approves this, and which I don't see any reason why they wouldn't, we could see outsized earnings growth because of the Inflation Reduction Act in many utilities as well. So I think it's a very interesting space, even though it's never talked about and it's typically boring, but the returns in the long term are, on the index are very similar to the S&P 500. And if you have a big drawdown, your forward returns are probably going to be better than the S&P 500. At least, that's the way I'm thinking about it right now.
Interesting stuff. And I guess that's part of the challenge of thinking about stocks generally is, we get caught into our typically our comfort zone. We tend to have types of companies we tend to gravitate toward, and you need to come at this with fresh eyes and a willingness to see where opportunity may be at a given moment in time, which you are doing, Brian. And that's a great point that if people are thinking as they, look at their own portfolio and they may have had stocks that they've had forever and have a lot of capital gains embedded in them and some of the challenges that presents with whether to make changes or not. There can be times when it makes sense to have a fresh set of eyes, look at your account and where you're invested and how it's positioned and where there may be opportunities at a given moment in time may be different from where it's been in the past. We tend to get emotionally attached to stocks because it's been good to me, kind of mindset. And as much as that is, understandable that at times we've had good experience, that's not necessarily what we want to be thinking about as we look toward the future. And if people would like some help in that process, you can always reach out to our team here at Asset Management Resources. And we might be able to be a resource to you in thinking about, are you positioned well? Do you have the right composition in your portfolio for your risk profile? People go through different changes in their life, in their lifestyle. And, are they positioned with the right structure for where you're at now as to compared to where you may have been at one time? If you'd like some help in that process, reach out to us at Asset Management Resources. AMRfinancial.com is the website, or you can always reach out by telephone, 508-771-8900, or toll-free 866-771-8901. Guys, really interesting discussion. Thanks for bringing it to us. Appreciate it.
You're welcome.
All right. We'll, until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll-free at 866-771-8901 or send us your questions to radio@amrfinancial.com.